AT&T is one of those companies that has been around for decades. It has a long, convoluted history of mergers and acquisitions, but the origin of the company can be traced back to two companies, the American District Telegraph Company in 1878 and the original Bell Telephone Company in 1877. As of this year, AT&T is the 30th biggest American company by revenue, with $120.7 billion in 2022. Now, all of this sounds very impressive. Massive company, fascinating legacy, but what's important is how AT&T currently performs and what we can expect in the next few years. AT&T released their latest earnings on 26th of July. The results were okay. The non-GAAP EPS came in at $0.63, beating expectations by 5%. Meanwhile, revenue came in at $29.92 billion, which was 1% under expectations. If we look at some of the highlights, we can see that revenue went up almost 1% as compared to last year, which is nothing crazy. On the bright side, AT&T generated $4.2 billion in free cash flow, which was more than 10% higher than the estimates of $3.77 billion. Management again reiterated their guidance of $16 billion in free cash flow for 2023. They're also committing to cutting net debt by $4 billion this year. This is good to see. One of the main reasons why AT&T had the spin-off last year was to focus on controlling expenses, making its business leaner and more efficient. It looks like the management is keen on delivering that, which is a big plus. Debt wasn't that big of a problem until last year, but with interest rates at almost 5.5% right now, AT&T can really take a hit if they are not careful. About $12.6 billion worth of long-term debt comes due within the next 12 months, and AT&T needs to either pay this off or issue new bonds. If the stock pays off $4 billion worth of debt, like the management says, that still leaves AT&T with $8.6 billion that they need to reissue at much higher rates. The current bonds have a coupon of between 1 and 2.4%, but there is no way AT&T can reissue those at anywhere less than 6%. What does this mean? It means more interest expense, and that could become a massive problem for AT&T. I'm not saying it will, but this does depend on how long interest rates will stay up. The market does expect that interest rates will start going down during the second half of 2024, as we can see in the yield curve. But what if they don't? We have had historically low interest rates for over a decade, and a lot of people think this is the new normal. But is that the case? There's a lot of arguments for both sides, and I'm not going to go into them. The main thing I wanted to point out here is that interest rates are currently one of the biggest problems for AT&T. And here is another reason. AT&T is not a growth stock. Revenues are expected to grow at an annual rate of about 1%. Earnings are expected to grow at an annual rate of 1 to 2%. Meanwhile, telecoms are a very capital-intensive business, meaning that AT&T needs to keep plowing back billions of dollars into maintenance and keeping its infrastructure up to date. Plus, they have competition from the likes of Verizon and T-Mobile. On one side, we have a very low growth. On the other side, we have competition and increasing expenses. Can AT&T keep up? I won't lie, but it doesn't look to me like the odds are in their favor. The market sees it that way too. Just look at AT&T's valuation. 90% of the time, you see a stock trading at PE ratios of 5 or 6. You see a stock which investors have given up on. Obviously, AT&T is part of the S&P 500, so you have a lot of index funds buying the stock and propping it up. However, such a low valuation should immediately start ringing some alarm bells. The current AT&T yield of 7.8% is actually higher than its PE ratio. That's absolutely insane. This is also the main investment case for AT&T in my opinion. The company is dirt cheap. If the company does succeed in saving the company, this could turn out to be very profitable. Plus, you have a solid dividend yield which could grow. AT&T could become a good turnaround play, absolutely. However, the chances of this happening are pretty low. I would put them at around 10 to 20%. In my opinion, AT&T will most likely float around for another 10 or 15 years, delivering below market performance until it eventually dissolves, gets taken over, goes bankrupt or something like that. During that time, it will continue to appear undervalued and a great dividend opportunity, but it won't be. Don't be fooled by the dividend yield. There's a lot of hidden pitfalls with AT&T and it's easy to get fooled, but a quick objective look at the business will show you that this is a very risky company to own. Just look at the company's total return over the last 10 years, or ask any existing AT&T shareholder. A lot of share owners I've seen on forums and commenting on my previous AT&T analysis wish that they had sold years ago, but stayed around because of the dividend. Now, I have to admit, I did buy 70 shares of the company when it was trading at about $14.5. However, I want to get rid of them as soon as I break even. Your money is better off sitting at a global index fund or an S&P 500 index fund. Less risk, more opportunity. Anyway, that's what I think about AT&T. What do you think? Am I overlooking its potential, or is AT&T a stock to avoid? Let me know in the comments below. Please leave a like and share the video if you enjoyed it. Thanks for watching, and I'll see you again soon.